The announcement of tariffs on trade partners by newly elected US President Donald Trump sent shockwaves through global financial markets, triggering a significant reaction from key international creditors of the United States. Among the most consequential moves in response to this aggressive economic stance was the large-scale sell-off of US Treasury holdings by China, Japan, and Saudi Arabia. This sudden shift in investment strategies from these economic powerhouses marked a turning point in international financial relations, exposing vulnerabilities in the US debt market, while highlighting the broader geopolitical consequences of Trump's trade policies. Before we start, smash the like and subscribe buttons for more updates. For years, the United States had relied on foreign governments, particularly China and Japan, to purchase and hold significant amounts of its treasury bonds. These purchases helped finance US government spending while keeping borrowing costs low. China, as the largest foreign holder of US Treasuries, had long used its investments as a form of economic leverage, maintaining a delicate balance between financial stability and geopolitical competition. Japan, a close US ally, had also been a major buyer, contributing to the liquidity and attractiveness of US debt. Meanwhile, Saudi Arabia, which had historically accumulated US Treasuries due to its petrodollar reserves, found itself re-evaluating its financial strategy in light of Washington's new protectionist stance. The introduction of tariffs by Trump was seen as a direct threat to global trade dynamics, and major US creditors responded by offloading their holdings in a calculated move that signaled growing uncertainty about America's fiscal and trade policies. As these nations reduced their exposure to US debt, concerns mounted over the potential rise in US borrowing costs, the strength of the dollar, and the broader implications for global economic stability. The sell-off of treasuries sent yields climbing, making debt servicing more expensive for the US government. At the same time, it put pressure on the Federal Reserve to reassess its interest rate policies in response to shifting market conditions. China's decision to reduce its treasury holdings was particularly significant, given the ongoing trade tensions that had been simmering between Washington and Beijing. The Chinese government viewed Trump's tariffs as a hostile measure that would directly impact its manufacturing sector and overall economic growth. Selling off US bonds was not only a financial response, but also a strategic maneuver, showcasing Beijing's willingness to counter US economic aggression with financial measures of its own. By offloading treasuries, China aimed to signal its displeasure while simultaneously testing the resilience of US markets. The move raised speculation about whether China would intensify its approach, possibly using its vast reserves as a weapon in a financial confrontation with the United States. Japan's participation in the sell-off, though somewhat less dramatic, was still a notable shift in strategy. Despite its historically strong alliance with the United States, Japan's economic interests were deeply intertwined with global trade, and Trump's tariff policies created an environment of uncertainty. Japanese policymakers had long relied on a combination of currency interventions and treasury holdings to stabilize their own economy, but the new wave of protectionism coming from Washington forced a reassessment. Tokyo's gradual reduction in treasury investments reflected a cautious but clear signal that it would not passively absorb the negative consequences of US economic policies. Saudi Arabia's decision to sell off a portion of its treasury holdings added another layer of complexity to the unfolding financial realignment. The kingdom had historically used its vast petrodollar reserves to invest in US debt, ensuring a stable relationship with Washington. However, the prospect of an economic slowdown resulting from trade disruptions, coupled with shifting alliances in the Middle East, led Riyadh to reconsider its investment approach. The move also fueled speculation that Saudi Arabia might be looking for alternative investment opportunities, including strengthening financial ties with emerging markets such as China and Russia. The cumulative effect of these sell-offs was an increase in volatility within US financial markets. As major foreign holders of US Treasuries reduced their positions, bond prices fell, causing yields to rise. This made borrowing more expensive for both the US government and American corporations, potentially slowing down economic growth. Investors reacted with heightened caution as the sudden shift in global capital flows added a layer of unpredictability to an already tense economic environment. Concerns over the long-term stability of US debt markets became a topic of intense debate among analysts, as some feared that sustained divestment from foreign holders could undermine confidence in the dollar as the world's reserve currency. The geopolitical ramifications of these financial moves were equally profound. China's divestment in particular underscored the evolving power dynamics between the world's two largest economies. While the United States had traditionally assumed that its debt would always be in high demand, Beijing's actions demonstrated that such assumptions could no longer be taken for granted. The financial interdependence between the US and China, often described as a balance of financial terror, was being tested in a way that had far-reaching consequences. If China continued to sell off treasuries at an aggressive pace, it could weaken the dollar, drive up US borrowing costs, and introduce a new layer of complexity to the already volatile trade negotiations between the two nations. Japan's role in the sell-off also had broader implications, particularly regarding the future of US-Japan economic relations. While Japan remained a crucial ally, its willingness to adjust its treasury holdings indicated a growing wariness of Washington's unpredictability. The shift suggested that Tokyo was preparing for a more fragmented global financial system, one in which reliance on US debt as a safe haven investment might no longer be as viable as in previous decades. This recalibration hinted at the possibility of Japan diversifying its reserves by investing more heavily in alternative assets, including European and Asian markets. For Saudi Arabia, the sell-off was a reminder that economic interests often dictate diplomatic strategy. Riyadh had traditionally aligned itself with Washington in financial matters, but Trump's trade policies introduced a new level of unpredictability that made diversification a more attractive option. As the kingdom sought to expand its economic partnerships beyond the United States, its willingness to offload treasuries was seen as a potential shift toward a more independent financial strategy. This was particularly relevant given the ongoing transformations in the global energy market, where Saudi Arabia was actively exploring new trade relationships with China and India. The immediate impact of these sales on the US economy was a subject of intense debate. Some analysts argued that the United States, with its deep and liquid financial markets, could absorb the sell-off without long-term consequences. They pointed out that even if China, Japan, and Saudi Arabia reduced their holdings, other investors, including domestic buyers and institutional funds, would step in to fill the gap. However, others warned that if the sell-off continued at an accelerated pace, it could lead to a more pronounced increase in interest rates, potentially slowing down economic growth and making debt servicing more expensive for the US government. Another concern was the possibility that the selling spree could trigger broader shifts in global financial markets. If major US creditors no longer saw treasuries as the preferred safe haven asset, there could be a movement toward alternative investment vehicles such as gold, cryptocurrencies, or government bonds from other developed economies. This potential diversification away from US debt could weaken the dollar's dominance in global trade and finance, leading to a more multipolar financial system where economic influence was more evenly distributed among major players such as China, the European Union, and emerging markets. The timing of these sales also raised questions about the future trajectory of US fiscal policy. Trump's administration had already signaled its willingness to engage in aggressive economic policies, and the sell-off added another layer of pressure on policymakers in Washington. If foreign demand for treasuries declined significantly, the US government might have to adjust its fiscal strategy, potentially leading to either higher taxes, reduced government spending, or increased reliance on domestic debt buyers. This, in turn, could have political ramifications as Trump's administration would have to navigate the economic consequences of its own policies while maintaining its commitment to growth and job creation. Overall, the decision by China, Japan, and Saudi Arabia to sell US Treasury holdings following Trump's tariff announcement marked a critical moment in global economic relations. It underscored the interconnectedness of trade and finance, demonstrating that economic policies could have far-reaching consequences beyond their immediate targets. The move also highlighted the growing willingness of major economic players to assert their financial independence, challenging the long-standing assumption that US debt would always be a universally trusted investment. As global markets adjusted to this new reality, the stage was set for a period of heightened uncertainty. where financial strategies became increasingly intertwined with geopolitical maneuvering. The rapid shift in US Treasury holdings by China, Japan, and Saudi Arabia in response to Donald Trump's tariff announcements did more than just destabilize financial markets. It set off a chain reaction that reverberated across multiple sectors, challenging economic alliances, trade policies, and the global financial order. As each of these major US creditors reassessed their financial positions, the broader implications became increasingly evident. The global economic system, which had relied on a predictable pattern of investment in US debt, was now entering an era of uncertainty, where geopolitical tensions directly influence capital flows. One of the most immediate effects of this large-scale Treasury sell-off was the rising cost of US government borrowing. The Treasury market operates on supply and demand dynamics, meaning that when major holders begin liquidating their positions, prices fall and yields rise. Higher yields on US government bonds may have seemed beneficial for investors seeking greater returns, but for the US government itself, this meant an increased cost of servicing its already massive national debt. At the same time, businesses and consumers felt the ripple effects, as rising yields on government bonds often led to higher interest rates on mortgages, corporate borrowing, and credit lines. This increased borrowing cost had the potential to slow economic growth, creating an ironic scenario where Trump's tariffs, aimed at boosting the domestic economy, could inadvertently lead to economic stagnation. As bond yields climbed, concerns over inflation and monetary policy adjustments intensified. The Federal Reserve, which was already navigating complex monetary decisions, faced pressure to either accommodate the shifting debt market or risk further economic instability. If Treasury yields continued to rise at an accelerated pace, the Fed would have had to decide whether to intervene by purchasing bonds to stabilize the market or allow yields to rise naturally, even at the risk of slowing economic expansion. The uncertainty surrounding these decisions led to volatility in stock markets, as investors questioned the long-term impact of shifting capital flows on both the bond and equity markets. China's decision to reduce its Treasury holdings was particularly notable because it was not merely a financial maneuver, but a deliberate geopolitical statement. For decades, Beijing had been accumulating US debt as part of its broader economic strategy, ensuring it maintained leverage in economic negotiations while simultaneously safeguarding its foreign currency reserves. By selling off treasuries, China signaled its willingness to use its vast holdings as a countermeasure against what it saw as aggressive US trade policies. While Beijing did not want to completely destabilize the US financial system, since doing so would also hurt its own economy, it demonstrated that it was willing to challenge the traditional financial interdependence between the two nations. The shift in China's financial strategy also raised questions about alternative investment avenues for its foreign reserves. If China was decreasing its reliance on US Treasuries, where would it redirect its capital? The most immediate alternatives included European bonds, gold reserves, and direct investment in strategic industries. Increased Chinese investment in European markets posed new challenges for US policymakers, as it potentially strengthened economic ties between China and the European Union at a time when Washington was looking to isolate Beijing economically. Additionally, a greater emphasis on gold reserves suggested a move toward reducing reliance on the US dollar, a prospect that could accelerate global de-dollarization efforts. Japan's decision to participate in the sell-off, though less aggressive than China's, still carried significant implications. Unlike China, Japan had historically maintained a more cooperative financial relationship with the United States, largely due to its security alliance and economic interdependence with Washington. However, Trump's protectionist stance forced Japan to reconsider its financial strategies. By selling off US Treasuries, Japan was not only hedging against potential economic disruptions, but also sending a message that even America's closest allies would not blindly absorb the consequences of its unilateral trade policies. For Japan, the Treasury sell-off also represented an opportunity to diversify its foreign exchange reserves. Tokyo explored increasing its investments in Asian markets, strengthening economic ties with regional partners as a counterbalance to the uncertainty stemming from Washington's trade policies. This shift suggested that Japan was positioning itself to be less reliant on US financial instruments while simultaneously seeking greater economic independence. If this trend continued, it could signal the beginning of a long-term realignment in global financial power, where even traditional U.S. allies pursued more diversified investment strategies. Saudi Arabia's participation in the sell-off brought additional geopolitical dimensions to the situation. Unlike China and Japan, Saudi Arabia's decision was not purely financial, but was also influenced by shifting regional power dynamics and energy market considerations. The kingdom had long been a major purchaser of U.S. debt due to the petrodollar system, which ensured that Saudi oil sales were conducted in U.S. dollars, reinforcing the economic ties between Riyadh and Washington. However, with Trump's tariffs potentially disrupting global trade, Saudi Arabia had to reassess the stability of its treasury holdings. The shift in Saudi investment strategy suggested that the kingdom was looking for alternative ways to secure its financial future. As global energy markets evolved and competition from renewable energy sources increased, Saudi Arabia needed to ensure that its financial reserves were protected from economic volatility. By reducing its exposure to US Treasuries, the kingdom signaled that it was open to diversifying its investment portfolio, potentially increasing its financial dealings with China and Russia. This shift raised questions about the long-term sustainability of the petrodollar system, as any significant move away from US dollar-denominated assets could have profound implications for global finance. The sell-off also had immediate consequences for global currency markets. As China, Japan, and Saudi Arabia reduced their treasury holdings, the value of the US dollar faced downward pressure. While a weaker dollar could have made US exports more competitive, it also had the potential to fuel inflation by making imported goods more expensive. The Federal Reserve had to weigh the implications of a declining dollar against the broader economic impact of rising treasury yields, creating additional complexity in monetary policy decision-making. At the same time, the move by these nations to reduce their U.S. Treasury holdings raised concerns about the broader trend of de-dollarization. If major economies sought alternatives to U.S. debt, it could accelerate the push toward a multipolar financial system, where the dollar's dominance was gradually eroded in favor of a more diversified set of reserve currencies. China had already been promoting its yuan-based trade initiatives, and the Treasury sell-off further reinforced the idea that Beijing was serious about reducing its dependence on the dollar. If other nations followed suit, it could challenge the long-standing role of the dollar as the world's primary reserve currency. In financial markets, the uncertainty surrounding foreign treasury sales led to increased volatility as investors attempted to gauge the long-term implications of shifting capital flows. Hedge funds and institutional investors closely monitored bond auctions to assess whether domestic buyers would step in to replace the lost demand from foreign holders. If U.S. investors were unwilling or unable to absorb the excess supply of treasuries, it could result in sustained upward pressure on yields, making borrowing more expensive across the board. The banking sector also faced potential risks from the shifting treasury market dynamics. Since U.S. Treasuries serve as a foundational asset for financial institutions, any significant disruption in their value could affect liquidity conditions in the banking system. If yields rose too quickly, banks could see a decline in the value of their bond portfolios, potentially impacting their ability to lend. This, in turn, could slow economic activity, creating additional headwinds for growth at a time when the Trump administration was pursuing aggressive trade policies. For U.S. policymakers, the sell-off served as a stark reminder of the interconnected nature of global finance. While Trump's tariffs were intended to create economic advantages for American industries, the broader financial consequences highlighted the risks of pursuing protectionist policies without considering their ripple effects. The loss of foreign demand for treasuries not only made borrowing more expensive, but also raised questions about the long-term sustainability of U.S. debt. If major creditors like China and Japan continued to reduce their holdings, Washington might have to rethink its approach to fiscal policy, potentially leading to difficult decisions regarding government spending and taxation. The broader geopolitical landscape was also affected by the Treasury sell-off. The event underscored the growing willingness of major economies to use financial tools as a means of exerting influence. If China, Japan, and Saudi Arabia continue to strategically adjust their treasury holdings in response to US policies, it could mark the beginning of a new era where economic power was wielded as a direct instrument of geopolitical strategy. This shift had the potential to redefine international relations, making financial markets an even more integral part of diplomatic negotiations. As markets absorbed the impact of the sell-off, the long-term implications remained uncertain. Would the United States be able to attract new buyers for its debt? Or would it have to adjust its fiscal policies to accommodate changing demand? Would China and Japan continue reducing their exposure, or was this merely a temporary reaction to Trump's tariffs? Would Saudi Arabia's shift in investment strategy lead to a broader realignment of global energy and financial markets? These questions loomed large as investors, policymakers, and analysts attempted to navigate the new financial landscape created by Trump's economic policies. The sell-off of US Treasuries by China, Japan, and Saudi Arabia was more than just a reaction to tariffs. It was a signal of shifting global economic power. The interconnectedness of trade, finance, and diplomacy was on full display, demonstrating that no policy decision exists in isolation. As the dust settled, one thing was clear: the global economic order was entering a period of profound transformation, with consequences that would shape financial markets, international relations, and economic policies for years to come. If you liked this video, please give it a like and subscribe to our channel. Also, leave your comments below and tell us, what are your thoughts on China, Japan, and Saudi selling US Treasury holdings after Trump's tariffs? We want to hear from you. Thank you for watching, and see you next time.